Three.
Good afternoon, everybody. This is David Marsh from OMFIF. It's a great pleasure to welcome Philip Lane, who's the member of the board responsible for economics at the European Central Bank. He's really been at the ECB in a most engaging and active period for all the reasons you know about. Before that, he was the governor of the Central Bank of Ireland, and before that, he was a very distinguished economist and academic at Trinity College in Dublin. So you're going to be talking for about 20 minutes on the ECB strategy review and the challenges for monetary policy. We will then have a series of questions from a panel, and we will also be inviting the audience to put in questions through the chat button. Please do that. All of this is totally on the record, and it'll be on the ECB website as well, the speech that Philip is about to make. So over to you. Looking forward very much to your remarks, Philip.
Thank you, David. Good afternoon, everyone. So in these opening remarks, I just wanted to explain the process of the strategy review, and the slide deck will be on the ECB website, but there's no actual written text. So let's go to the next slide. So really, I think the way to think about it is this is the first review in 18 years. The last review concluded in 2003. I think it started autumn 2002. So it is an 18-year gap. So I think it made sense for us to go for this wide scope to cover all aspects of the ECB monetary policy. I think it made sense for us to say, well, let's really try and be universal about this. Let's not just run it here at the ECB, but also widen it to be a full Eurosystem approach. What does that mean? It means for all of the topics covered, there have been fairly large teams across the Eurosystem between the ECB and the national central banks working away on various topics, subtopics, and subtopics. So it's been very interesting, I think very rich for the Eurosystem to have that kind of wide approach. Now, of course, it'd be a mistake only to kind of listen to ourselves. So it's been important also to listen to others. And I think that's taken a range of formats. Now, as you might expect, we've had roundtables with academic experts. We've had roundtables with legal experts. And we've also engaged, with the general public and civic society through various types of listening events. In part at the ECB, but in part, I think, via national central banks. So there's been across the Euro area, national events also. Now, we've learned quite a bit from those listening events in terms of what concerns the public has, what they might expect from monetary policy, their view, if you like, of inflation and the role of monetary policy. And also, very importantly, we've had repeated engagements with the Econ Committee of the European Parliament, which, of course, is a very important element for us in terms of our official lines of accountability and reporting. And by the way, I should say also, it's been interesting, and we actually learned quite a bit from internal town halls at the ECB, because the ECB has thousands of staff members, only some of whom are monetary economists. We have all sorts. And of course, we have all the different generations. And of course, different generations have probably quite different views of monetary policy these days. So that kind of process, as I say, has been quite interesting. Next slide. Now, in terms of timeline, we did start. We planned this actually late 2019. We were launching early 2020, but of course, we got diverted during the acute phase of the pandemic. Now, that did kind of delay some of the work for a little bit. But really, since last summer, we've been very busy with different elements of this review. And, we've committed to finishing in the second half of this year. Now, how does the work get to the Governing Council? We've had a series of seminar debates where essentially we absorb the analyses created by the ECB staff and the Eurosystem work streams. And we've kind of, tried to synthesize all of that to form the basis for a debate among Governing Council members. But it's also important to be aware that, of course, pretty much all topic is interlinked with every other topic. So, in this sequence of debates, it remains the case that in the end, we will have to draw all of this together to integrate it, to synthesize it before making final conclusions. So we've been very much in the mode of listening, work, to discussing the different issues, as opposed to kind of making final decisions. Next slide. So, in terms of the structure, let me take you through the structure of the review. So, of course, step 0 for any review process is to take stock. So if you go back to early 2020, at the start of this, we would, it was important to look backwards over the first 20 years of the euro, and especially look back saying, well, what do we know in 2003 and what do we know today? So it's important to have a solid footing in terms of a common understanding of the first 20 years of the euro. And of course, maybe having made that initial stock take, I'm sure it's generally correct that, as we go along and as we dive into particular topics, then I think all of us might update our views of the last 20 years of the euro as we get deeper into different topics. Because all of this work, of course, draws on all of the analysis that has been done over those years. Now, next step was to take on inflation, to understand what has been the evolution of inflation, and also to take on some measurement issues. So, of course, we all know that average inflation, in the last 7 or 8 years is clearly below average inflation in the first 10 years of the euro. And of course, that's in part as a global phenomenon, but there's definitely some issues that are specific to the euro area. So understanding the mix of negative shocks, understanding the mix of essentially the lower bound on interest rates, understanding the contribution of the financial crisis and the aftermath of the financial crisis are all elements of that. And of course, all of those intersect with structural changes in the world economy, whether it's demography, digitalization, globalization, and of course, a very prominent structural trend for all central banks is the trend decline in the equilibrium real interest rate, the famous R star. And of course, that's a fairly pervasive phenomenon. Okay, next, once you try and think you understand what drives inflation, it naturally leads you into the question, well, what should we aim for? What should be the, when we convert our price stability mandate into some kind of aim for monetary policy, what should be the anchor for monetary policy? And of course, that was an issue at the start of the euro, is an issue in 2003, and in 2003, the conclusion was to clarify that really what the ECB should aim for is an inflation rate below 2, but close to 2. And the set of issues that were studied then remain very relevant today. So having an inflation buffer above 0, the classical arguments were the existence of downward wage rigidity, nominal wage rigidity in particular, called for recognizing that in terms of greasing the wheels of adjustment. A second issue, which again is global, is our issue of measurement bias, given quality adjustments, new goods, and so on. And then the third element, which is important for a monetary union, is facilitating cross-country adjustment. Is it the case having an inflation buffer makes it easier to accomplish real exchange rate adjustment where needed, for example? So on top of those three classical reasons, the fourth reason, which is, obviously was not so relevant in '03, but it's definitely relevant today, is the effective lower bound. So if you have a trend decline in the equilibrium real rate and a lower bound exists, then globally, that's a pretty universal consensus that in order to preserve interest rate capability, by and large, it's important to have target a positive inflation rate in steady state, so that nominal interest rates in steady state are sufficiently away from the lower bound to give you monetary policy space in a downturn. So all of those issues are super relevant. Okay, so next, once you've decided what you want to do, the question is, how do you get there? What instruments do you use? So of course, there's a hierarchy here. It remains the case, the kind of lead instrument always is the short-term policy rates, set of short-term policy rates, which of course right now, the binding one is the deposit facility rate. But, and again, it's fairly universal, given the effective lower bound, it's important to augment the short-term policy rate with other instruments in order to limit or mitigate the impact of the lower bound. So that includes using asset purchasing. That includes forward guidance. It includes, by the way, creating more space by exploring the space below zero in terms of the short-term rate. And it includes targeted lending operations, like our TLTRO program. So it's important always for us to look back and review the effectiveness of these instruments, review the kind of our decision-making approach. How do we decide the right balance between these instruments, and to think about criteria for using these instruments in the future. So that's been super important part of the review so far. Next, we also needed to take on the topic of climate change, because of course, on a forward-looking basis, we know that the world has a major policy agenda in front of it between now and 2030 and also between now and 2050. So on top of the implications for macroeconomic volatility of climate shocks, bad weather or hot weather, depending on the season, already has been quite important in driving fluctuations in the euro area. But we also know that the transition to a zero carbon or negative carbon economy is going to be a major structural shift for the European economy and the world economy. So we need to understand that structural change. A basic principle is if it happens in a planned, structured, sustained, gradual manner, the implications are much lighter than if it happens with more dramatic and unplanned or sudden policy shifts. And in particular, if the transition is delayed so that larger policy changes are needed later on. So, in terms of the basics of how we understand the economy, which is a precondition for setting monetary policy, climate change is very important, but also is relevant for our monetary policy instruments and our framework. Because, of course, in designing asset purchase programs, in thinking about our collateral framework and so on, these considerations are also relevant. Now, next, we've been looking at financial stability. And again, it's important to emphasize this is pretty wide-ranging. And of course, compared to early 2020, when we started a review, the pandemic came along. And of course, we had to take a large-scale monetary policy action a year ago, where the interconnections between financial stability and price stability and economic stability were to the front of our minds. So that just gives you one example of how financial stability is relevant for monetary policy. Let me emphasize, it's not only about the overall monetary policy reaction to in the event of a looming financial crisis. It's also about the interconnections between monetary policy, for example, and macroprudential policy. It's also about the design of instruments, as is well understood, that for a given monetary policy stance, or for a given desired monetary policy objective, the design of our instruments, for example, the exclusion of household mortgages from TLTROs, the introduction of tiering of the charges on excess liquidity, can be attributed in part to mitigating the financial stability dimensions of a low interest rate environment. So that is, I think, has been an important topic. But it's important to emphasize it cuts in all directions. We have to think about what to do if a financial crisis arrives. We have to think about the tools, including macroprudential policies, which are now in existence, which weren't there 20 years ago, and how they might interact in terms of the dynamics of credit, for example. Now, in all of our thinking about monetary policy, the work that we rely on, the analytical work, was also widely reviewed. And traditionally, if you like, there's been a long-term image that monetary policy at the ECB has relied on two pillars of analysis: economic analysis and monetary analysis. And of course, in turn, that goes back to kind of two views of how to think about the inflation process, especially in the medium term. Now, it's important to emphasize is that when we think about it these days, of course, it's important to recognize that even if monetary aggregates do not have huge predictive power for inflation over most horizons, and at least in terms of the central distribution of inflation, monetary and financial analysis is super important for a wider range of reasons. Maybe number one is it's important to recognize the distinction between economic analysis and monetary and financial analysis can only go so far. We know the behavior of the economy is heavily conditioned by financial frictions, macro-financial multipliers of all dimensions. So it's very important to understand the monetary and financial system if you want to understand economic dynamics, including inflation dynamics. It's also essential in basically calibrating our policies, because of course the way our policies are transmitted is via the financial system, or at least a very important part of it is via the financial system. So we have to understand each chain of the transmission mechanism, from our policies to money markets, from our policies to the behavior of banks, from our policies to behavior of the bond market. So in fact, monetary and financial analysis is super important at the ECB, and will continue to be so, and it maybe even more so than before. So I think it's important that we understand, by the way, the ECB has been really, when you look at the ECB as a research institute, for example, we've really been a leader in developing the integration of economic, monetary, and financial analysis. I mean, other topics we have, of course, we have to think about communications. It's very important that we communicate our monetary policy as well as we can. And of course, in a modern age, the kind of communications mechanisms now compared to '03 are very different. We have to think about, and a kind of the permanent topic of monetary fiscal interactions. So 20 years ago, and of course, stitched into the treaty, is the recognition that monetary policy can be most effective if fiscal policies are kind of embedded in a sustainability framework. So we need fiscal policies to be sustainable. But what's also true, and especially in a world of low interest rates, is fiscal policy, by acting countercyclically, is an important conditioning factor for monetary policy, and that works in both directions. So we do have to kind of think about a world in which fiscal policy is important in terms of the overall cyclical properties of the economy. And then maybe the last box here refers to employment, because it's important in thinking about of our policy that, of course, we're focused on inflation, but in the same way our monetary policies might have side effects in relation to the financial system, they definitely have side effects in terms of employment, because of course the evidence base that employment is quite sensitive to the stance of monetary policy is pretty strong. And therefore, it makes sense in that direction in terms of side effects for us to understand it. But also, maybe I'll emphasize in the other direction that our technology now, in terms of the ability to take into account the heterogeneity of the labor market, high skill, low skill, age distribution, income distribution, again, in terms of calibrating our policies, understanding how employment and by extension consumption responds to different monetary policy decisions is very important for understanding our overall effectiveness. So I think, David, let me stop there. That's tries to give you a tour. You can see, the way I set up this graphic is it sounds like these are all separate boxes. And we did try and organize it like that. But I could have drawn a graph where I include a lot of interconnection lines across all of these different boxes to underline that there's a lot of interaction and traveling back, looping around to bring all of this together. So let me stop there.
Okay, thank you very much, Philip. Yes, I was going to say it looked a bit like a kind of magical mystery tour, but we know, roughly speaking, where you're going to end up. There's quite a few questions coming in. One issue which you have raised a lot, you mentioned inflation, more than probably any other word there. Do you accept that inflation is likely to be a bit higher next year than you've been so far predicting, the 1.6%? Because you seem to be moving towards ending the PEPP with 1.6% as your current forecast. On the other hand, there's been quite a few changes in the world economy since the 1.6 was promulgated. We've had this massive US stimulus program. We've got the vaccinations and so on coming on better in Europe than had been seen, likely to lead to a big increase in growth in the third quarter. And we also had Janet Yellen, the former head of the Fed, yesterday, now Treasury Secretary, talking about the Fed potentially tightening because there may be some overheating in the United States. Are you willing to say that your inflation forecast is actually more likely to come out much higher than the 1.6% for next year based on what is going on at the moment?
So there's a lot packed in to that question, many subclauses in what you just said. It's been not very long ago did we do our March forecast. So let me go back to the March forecast. Now, in the March forecast, we were aware of the vaccinations. So the question is, compared to March, have we learned anything new about vaccinations? Have we learned anything new about the world economy? Have we learned anything new about the European economy in the kind of short number of weeks since the March forecast? Because a lot of those issues were already incorporated in the March forecast. So I think it's important always when we see news arrive, the question is the news simply confirming what we already had built in? So the fact that
sorry to interrupt, Philip, I'm pretty sure the American stimulus program wasn't fully built in because it hadn't all been fully legalized.
But let me get to what's in and what's not. So, but other elements like the fact that Europe is going to have a big acceleration in vaccinations in these weeks, that was built in. The fact that Europe is going to have a big unlocking of the economy in the coming weeks, that is built in. By the way, I should say, and I invite you to go back to the 1st of May 2020, when the staff unrolled their initial post-pandemic forecasts. They were remarkably, the baseline has been remarkably robust. Back then, a year ago, the calculation was the medical solutions would be taking hold in mid-21, which is essentially what's happening. So I think we've for the all year long, we've based our kind of assessment, our projection on basically a baseline that essentially is coming to pass.
Yes, but I mean, sorry to be a bit persistent, but the one thing that nobody knew clearly was the massive American stimulus, which is clearly
right, sure, but then
a huge change.
We did publish. To some extent, it entered the forecast because, of course, that fiscal stimulus, entered the bond market, pretty quickly. And we did publish, the staff published in the projections. They also said, well, here's what we think will be added on through the US fiscal stimulus. But it's important when we go meeting to meeting, we say, okay, let's have our list. That's one element on the list. Another element on the list is the fact that the bond market has continued to move. So we would also have to take into account the latest update in terms of nominal yields. We would have to take into account what our update on the world economy, which is not just the US. What we see in India is not good news, for example. And by and large, we have to update the global picture, which is not just the US picture. And then coming to the issue about inflation, it's very important to differentiate the near term from the medium term. I mean, I wrote a blog post a couple of weeks ago, which basically said a lot of the inflation surge this year is just unwinding the negative inflation shock last year. And if you average 2020 and 21 together, you'll get an average around 1%. And we do project when these various effects unwind, we will be in the low ones early next year. And in the March forecast, we do think inflation will pick up. And we were forecasting for 2023, a pickup in inflation, but only to about 1.4. So, and let me emphasize, inflation is mostly a domestic phenomenon. The fact that there's clearly a different macroeconomic configuration in the US, there's positive spillover to the world from the US, to the world economy, but the impact is limited by the kind of trade linkages. So it's important not to kind of read it across too strongly.
Thank you, Philip. I think I get the message. I just want to ask one more question before I then go on to Alison Ryan, who's the first member of the panel to ask you a question. But first of all, in your talk just now, you made this comment about inflation buffers and having a range actually would allow, therefore, different countries to also catch up in terms of competitiveness. Is that a coded way of saying that you would rather welcome the German inflation rate to be considerably above the average inflation rate, because that would indeed allow other countries which are less competitive than Germany to, if you like, catch up? We do see, as you know, a rise in the German inflation rate, which a lot of people may get quite hot and bothered about towards the end of the year, 3% and more, partly because of the domestic factors you mentioned. Is that a good thing that German inflation rate continues to be significantly above the euro area average? Would you actually recommend that?
Well, the point I was making is pretty universal, and it's also universally made 20 years ago, and no doubt before the euro as well, which is regardless of the identities of which country is in what position at a given point in time, as a universal principle, if whatever condition requires real exchange rate adjustment in the euro area, if you accept, which I do, I think the evidence is overwhelming, that it is difficult, if not downward nominal wage adjustment. It does make the case for having a kind of a positive inflation buffer. An average inflation rate for the euro area, which is positive, greases the wheels.
Is that a coded way of saying, yes, to my...
No, but again, even there, I think, my kind of history as an international economist would also say, look, when we think about real exchange rate adjustment, it's by and large, it's about relative labor costs, which is not the same as relative HICPs. So I'm not going to make the one-to-one mapping from the fact that it might be different consumer inflation rates across Europe to saying, is this one-to-one helping real exchange rate adjustment? And by the way, my own academic career, I've always emphasized, for any individual member country, its trade weighted real exchange rate is really dominated by the external value of the euro. We overstate the intra-euro area element versus the extra-euro area element. But it remains true.
We'll bear that in mind, definitely. Let's go on to the questions, since there's a whole host of them and we've only got half an hour left. Alistair Ryan. Please, you're on mute at the moment.
Thank you. Good afternoon. It's a question on slide 4, really, the interaction between the boxes. Monetary policy instruments, financial stability, the TLTRO, key tool for the ECB now, used to influence credit conditions, but with less and less effect bank by bank. I'm a banks analyst. What I can see is that the weaker the bank, the keener it is to use the TLTRO, the bigger the impact it has on the bank's behaviours, creating financial stability issues for the stronger banks. As the TLTROs are used more, they're more likely to be just redeposited back at the ECB, which is creating other financial distortions. So without a credit angle to the TLTRO, banks don't make riskier loans because they've got more liquidity. They're already awash with liquidity. It's becoming quite a difficult tool from banks' perspective. How do you think about the trade-offs within that, please? Thank you.
Yeah, I mean, it's difficult to kind of make a connection between your description and the way I think about it, or indeed what I read from the bank lending survey. So when we ask the banks themselves, so it's important to keep in mind the T in TLTRO, that these are targeted, that it is essentially the funding provided is conditioned on meeting credit targets. And, in the heat of the crisis last year, the target was said, well, let's keep credit from contracting. Let's avoid a credit squeeze. So we do think in the bank-based system that we have in the euro area, that it, and the fact, and especially in this round where we did cut the kind of funding rate to below the deposit facility rate, that we've seen a huge take-up. Now, so not every generation of TLTROs have the same impact, but this generation of TLTROs has, we think, a large impact. We think it's not only about today, but it's also about the next couple of years in terms of making sure banks are able to fund the recovery in investment that we anticipate. So actually, I mean, I do think everyone's views, our views, and maybe the outside world views of the role of TLTROs probably will need to be updated after this round, because all monetary policy has a different effect depending on how stressed the world is, and also in terms of the kind of demand for credit situation. So we're quite optimistic that the current round of TLTROs is proven effective. Let me say is that maybe unlike some previous generations, the take-up is extremely broad. So it's not the case that it's only banks who find it difficult to raise wholesale funding have tapped TLTROs.
Good. Well, I'm going to cut you off there, if I may, because we've got a whole load of other questions. It sounds to me, Alistair, you've booked yourself on a flight to Frankfurt to have a teach-in on TLTROs with Philip. Could I ask Agnes to put your question now, please?
Yes, hello. I also have a question about instruments. You talked about reviewing the right balance of instruments at the ECB, and I'd like to ask your view about how to make the best of asset purchases, which have proved quite effective in this crisis and the past one. And in particular, would it make sense to you to maintain an active envelope of asset purchases, which may or not be used, while the ECB starts raising interest rates to avoid a disorderly normalization of the yield curve?
Okay, that's an interesting question, because the usual hierarchy, and it's built into our forward guidance, is we will stop net purchasing before we raise interest rates. So there's a clear sequence, which again I think is fairly global. That the historical kind of and it's really for the same logic as you have, but maybe in reverse, which is once starts, you do want to make sure you have an active monetary policy tool. So once you, so I do think it's important that you do have interest rates which have started to be raised, which allows you to make sure that you do have interest rate space after the end of net purchasing. So it's also true, as you know, we see with the Bank of England, the kind of sequencing between the end of purchasing and interest rates is going to be looked at, or is being looked at. So, I mean, I think it is a topic where, it's interesting to ask, is that traditional logic still robust? And I do think the starting point is it is robust. So the starting point, which is in our forward guidance, is to end net purchasing before liftoff. But philosophically, we should always be looking again at every topic. And as I say, I think the Bank of England has a study right now to look at that topic.
Okay, I'm going to bring in another question who I know has got a question about asset purchases, but just as a prelude to that, Philip, regarding the PEPP, which you're on track, I think, to end that at the end of March next year. The idea behind the PEPP is to end it when the crisis engendered by the pandemic is over. Do you think that the health crisis may be over by then, but the economic crisis will still be going on, and that might be a reason to carry on with the PEPP? This is just a prelude to another question which is coming along in a moment.
Well, let me take that on. I mean, with the PEPP, we did link it to the end of the coronavirus crisis phase. So it is very much connected to that. But as you indicated, we haven't, decided any kind of numerical rule for that. And I think we should be at this point, which is, and what we've said is end of March 22 or whenever the Governing Council concludes that the corona crisis phase is over. And I think it's important with this pandemic to kind of, to me, focus on the here and now. This is a long way away. And that, we've essentially got our guidance or provided the guidance that during this pandemic, we're going to be guided by maintaining favorable financing conditions in the context of making sure that the pandemic shock to the inflation path is offset. So, I think, I read, I can see, a lot of interest about what do you expect? And I think in the world we're living in with uncertainty, it's not super productive to focus on anyone's central expectation. As opposed to, the whole philosophy of PEPP is let's be responsive to how the world unfolds. So I think rather than focus on kind of central expectations, we need to make sure that PEPP does its job in terms of making sure that this pandemic is not amplified by a lack of monetary accommodation.
Sorry to press you on this, but just before the next question, at what range? 2 months, 3 months, 2 weeks? At what range would you be willing to say? Because you say you have to concentrate on the here and now. So at what range of forecasting would you be happy to say, well, this is either going to end?
Oh, sure. No, at some point. At some point, of course, we will have to, and it's also not going to be the last day of March next year.
No, so 3 months.
But it's conditional on the pandemic. It is conditional on the pandemic, both in a narrow sense in terms of the spread of the virus and its containment, but also in terms of its impact on the economy.
Okay,
let's
okay.
see.
No, I get your point. Let's go over to Emanuele. Manu, your question, please.
Thank you very much. So moving forward on Agnes and David's remark on the end of the PPP and looking forward at the inflation forecast, if we start looking beyond the PPP and start considering the APP as the remaining tool, and we look at the inflation forecast, you could imagine us being in an environment where more stimulus is needed to meet the inflation target. But with the APP limits, I was wondering how this will be possible, considering that you would require to do significant monetary stimulus to be able to reach that target. And the APP clearly has bond related limits as well as other limits. So would you consider changing them?
I mean, I think we try to be as clear as we can and in a very repetitive way that we stand ready to adjust all of our instruments in order to deliver the inflation aim. So I think, I mean, this is, I feel like a very common question I get asked. But I mean, the response in the end is we have a mandate. We have a mandate to deliver price stability. In our current formulation, we've, in 03, that was clarified to be aiming for an inflation rate below but close to 2%. And essentially, in order to deliver that mandate, we have to provide the monetary accommodation needed. So, I think rather than, it's important not to dwell on any particular detail of any particular program, because to repeat, we stand ready to adjust all of our instruments as appropriate to deliver that target. So, I do think that should be the guidance.
If I may, just to take up the thread of Manu's question, let's say you did decide to carry on because as you say, you can use all your instruments and you've got the mandate to follow. Let's say you did decide to have an instrument which didn't have the same limits as the APP. Would you be worried that you might fall foul of the German Constitutional Court and the European Court of Justice, which indeed say that those limits are actually very important, and you've been allowed just to sidestep them for the emergency, but they may not be so lenient if you were to try to use an APP without limits, for example, in the future under this very discretionary policy that you have.
But again, I think it's important to make a couple of points. One is, of course, we operate within a legal framework, and we're crystal clear about the European Court of Justice and its various rulings. But what's also true in those rulings is the importance of recognizing we do have a mandate, a treaty mandate. So everything has to be in the context of what is proportionate and necessary to deliver that mandate. So that essentially is always true. We're always super careful. Every central bank, by the way, in the world cares about limits. That they care about, what fraction of the different bond markets that they're holding. So, it's, I think this issue in terms of the overall monetary policy stance, you should always put that into the context of everything else. We provide liquidity through TLTROs. We set the level of the short-term interest rate. We have our forward guidance. So, I think if you look at the range of monetary policy instruments we have, it's very important to recognize that essentially we have a lot of capability.
That's extremely clear. Because time is pressing on, let's go on to the next question. So this is Christian Kopf, please.
Yes, thank you, David, and welcome. Hello from Frankfurt. I think my video is not really starting.
No. Don't worry, we can hear you loud and clear.
Very good. Philip, under your stewardship, the ECB is putting a lot of pressure, a lot of emphasis on conditioning financial markets. Do you see a potential conflict between achieving market stability and preserving the resilience of financial markets?
I think, Christian, I'm going to have to ask you to elaborate a little bit. I mean, what do you have in mind in terms of the trade-offs or the tension?
Well, basically, the violence of the market sell-off in March may have been related to the drip feed of central bank buying in the month running up to the crisis, which has led to a loss of market discipline. Yeah. So in a way, by putting so much pressure on markets and by trying to achieve favorable financing conditions, you take away some of the market discipline, and that basically leads to the situation when something small happens, you get an outsized reaction of financial markets, which may run counter to your initial intentions.
Okay, no, now I more fully understand your question. So I think there's kind of some general issues there, and then there's the kind of specific issue of what happened last March, which of course was not only in the euro area. And of course, if we think about the US, they did not have an active QE program going into the pandemic. And of course, there was a very large shock to the US Treasury market. So in the particular context of the pandemic last March, and also, by the way, of course, throughout most of 2019, we were not net purchasers, although we'd started again in late 2019. So in the particular context of last year, I'm not so sure. But there is a general point which is relevant to raise, which is the kind of when central banks have a large footprint in the bond market, how this alters the kind of incentives facing other participants. I mean, this goes back to the fact that we try not to be arbitrary. The reason why we do have this large footprint in the bond market is we do think it's necessary in order for the economy to recover from the crisis, that financial conditions are kept favorable. But maybe this is where the kind of line is drawn is we've also made clear that we're not doing yield curve control. We're not totally suppressing long end market pricing, and of course we do operate within limits. It's not the case that we're the dominant purchaser in the market, and we do want bond market discipline to play its role. So the question is, what is escapable and what is inescapable? Are there ways, in as we kind of execute what's necessary in terms of monetary accommodation? And what we do think, by the way, and I would sign up to this, is we also have to think about the macroprudential framework for non-banks, for the bond market and so on. Because of course, another narrative about what happened last March, maybe more in relation to money markets right on the long end, is whether the correct framework was in place to encourage a little bit of self-insurance on the part of those involved in the money markets and the bond market.
Yes, well, you've covered a lot of base. That's a very good food for thought there, Philip. Lots of bases covered there. I've got another question now from Mr. Caillot, please, Jacques.
Hello, thank you very much. Hi, David, Philip. The question is very much in the context of the recent literature, which has focused on the so-called lower for longer and make-up strategies. Could you give me your personal view on make-up strategies, and in particular, those that relate to forward guidance, which would include some form of overshooting in the context of historically low inflation?
Okay, thank you. I mean, I think again, it's important to recognize what must be universally true versus what is relevant in the particular context of a particular monetary system at a particular point in time. So, I mean, I think it's hard not to fully agree with the basic logic of when there is a lower bound and when the equilibrium real interest rate is low, that the ability of central banks to quickly correct negative shocks is constrained. Whereas that's not true on the other side. If you are if you have a positive shock, there isn't the same technological constraint on the ability to tighten policy. So that is a fundamental asymmetry, which has to be recognized. I think it's probably a universal principle coming out of that. It is that a degree of patience is required as inflation pressure picks up, because it's not any kind of agent. So whether it's an investor, a firm, a household, in trying to work out where will inflation be in the future, we'll look at the evidence. And if the evidence is a repeated observation of low inflation, that will, I think it's in the data, will influence beliefs about the future. And so the issue is, how do you convince or emphasize to everyone that is not the case, that there is even if there is a period of sustained low inflation, it remains the case the central bank wishes inflation to return to a higher number. And the issue of, I think it's something that should be reflected in forward guidance, but the exact formulation, the exact role of any kind of overshooting principle, I think it very much depends on the exact circumstances. So this is clearly something we are looking at and thinking about, but it's also the case, I don't think we have drawn any conclusions at this point.
I know you're a bit reluctant to talk too much about the future, Philip, but how likely do you think we are going to get into an overshooting situation of a durable kind, let's say, over the next 18 months to 2 years?
I really don't see it. I just don't see it. And this is why, it's important. In the end, I do think a precondition for persistent inflation is a strong labor market. And so the fact that there might be some bottlenecks in some commodities, the fact that the pricing power may have been rediscovered by some global firms, is not on its own enough to generate persistent inflation. You need a strong labor market. We do think the labor market is going to lag behind the overall recovery. We noticed the sectors which have been most hit by the pandemic are quite labor intensive. So it's important, like in the projections we had in March, even if we were projecting that GDP will come back to 2019 levels in Q2 next year, we don't have unemployment going back to 2019 levels until 2023. So yes. I really think it's important to differentiate the kind of any relative price adjustment we're seeing right now.
And would the same go for the exchange rate? We had a question in from the audience about the exchange rate. Would that be also accorded a relatively low significance if the euro were to be weak against the dollar, for example? You wouldn't expect that to increase markedly the inflation throughput.
Well, I mean, we do think the exchange rate is important for the European economy. It's quite an open economy. So the exchange, we were talking at the very start of this session about what goes into our forecast. And of course, movements in the exchange rate are kind of material for our forecast. But the exchange rate, has been, I would say, number one, has been relatively stable after a pretty significant surge. But it's the medium-term movement in the exchange rate matters for medium-term inflation. By and large, we view the exchange rate as a random walk. So we don't think we have ability to predict future movements in the exchange rate. But the exchange rate movement that's already happened is an influence on the inflation dynamic. And if there are future moves, they will be an influence on the inflation dynamic.
Okay, well, thank you very much. We've got a question also from Catherine Bosley from Bloomberg. Catherine, please put your question. You don't necessarily have to switch on your video. I don't think it's working, but just put the question.
Sure. I just wanted to ask, obviously, you've talked a lot about the importance of the strategy review and especially for inflation. And I just wanted to ask, lots of people are expecting a big fireworks from the ECB in June. And I was wondering if that was a good bet, or whether it might not be more sensible to wait until September, when you would have the results of this review and more forecasts and just a better sense of where the pandemic is headed.
So I mean, going back to the issue which I tried to emphasize earlier on, it is obviously it's relevant, the calendar for PEPP in terms of until the end of March 22, or with the Governing Council reserving its right to decide when the Corona crisis phase is over. But it's important to go back to, in the meantime, the way we're running PEPP is basically centered on a quarter by quarter assessment of the favorability of financing conditions, where favorability is essentially defined in the context of the inflation outlook. So it's very important to recognize that this is, there's no reason to believe this is a linear process. That we stepped, we basically over the course of PEPP, we had a very high rate of purchasing last spring. That came down in the autumn, and it was relatively low in the first couple of months of this year. And then we stepped up at the March meeting. But the whole philosophy of PEPP is basically to be responsive in a flexible way to basically the two components: what's happening to the inflation outlook and what's happening to the financing conditions, with a particular focus on market interest rates. And so, the issue of what happens in June, what happens in September, what happens next December will turn on those. And whether that's a linear process or whether it's a process involving revisions on a quarter by quarter basis will be driven by this basic criterion of asking, are financing conditions favorable in the context of the inflation outlook? So, I think it's important.
You've lowered the expectations of fireworks, I would say, Philip. Just on that, there's one or two questions I'd still like to get to, if I may, Philip. One is actually regarding what you've just been talking about. If you look at the figures, it seems as though the actual increase in your purchases under PEPP in, say, April was just about 15 to 20% higher than some of the weekly rates in January, February, i.e. not that much of an increase. Are you still keeping up a very cautious approach here? You're buying about 80 billion a month. Your run rate is very much in line with what you'd need to do to maintain this program until the end of March and then stop it. And then what do you think about potential lowering of the purchases as we get towards March? We won't call it tapering. We'll just call it a slow diminution. Is that something that you'd like to prepare us for?
Well, I think, as I just told you, it all depends on two forces. One is what's happening to the inflation outlook quarter by quarter, and then what's happening to financing conditions. And I think there's nothing magical to say both are going to move in reinforcing directions. They could move in opposite directions. So what needs to happen quarter by quarter, let's see. But it's been very important, going back to last December, is what we said is, we do have an envelope. We expanded the envelope to 1850, but we basically subordinated that to this commitment to maintain favorable financing conditions. If less is needed, we will go lower. But equally, if more is needed, we can upwardly revise the envelope. So okay. I think it's important. I mean, this is a very important pivot in how QE works. Because traditionally, it was easy. I mean, both in our own history and in how the central banks operate, you could basically summarize QE by basically saying, how much are you buying and for how long? But what we have done is subordinated that to this favorability of financing conditions. So I do think the focus should not be on the kind of a volume-based approach, because we've essentially said we can go lower, we can go higher, and it should be focused on, I mean, it's basically the long end version of how you might think about interest rate policy. Interest rate policy will be adjusted in line with the evolution of the economy, the evolution of the inflation outlook. And this is just the long end version of that. We will, be steering yields to our purchases in response to our updates on the inflation outlook.
Yes, it might be thought of as a 3 or maybe even 4-dimensional monetary policy. You could call it that. I've just got 2 questions left, if I may.
Sure.
One a very interesting one from the audience, which I'll just put anonymously, and then I'd like to ask Christian Kopf to put on his video in a moment because he's got a very nice tie that he wants to show you. But the question from the audience is: you made some remark about monetary fiscal coordination. Would that extend, do you think? So says the question from the audience, to telling the Euro finance ministers when they either have a too strong or too weak fiscal policy. Would that be part of what you could be doing? You could do it in a coded way, of course. You could do it in very polite language.
So I'm pretty sure what I referred to in talking about it was interdependence. So I think interdependence is blindly obvious. I did not say coordination, because we have our independence, we have our mandate, and I do think it's important that we make our decisions and the finance ministers of Europe make their decisions. But we do say in our monetary policy statement, we do call on fiscal policy to play its role. So that is already there. Essentially, we do highlight, and this was a high-level way, what we identify as desirabilities in terms of fiscal policy.
The governor of the Bank of England used to raise his eyebrows, and you can use the word roll, can't you, in an imaginative way? So I do understand you have to be a little bit guarded here.
Well, I do think it's important. To recognise. Pretty much all major central banks have legal independence. We're all in the same situation that the fact that we are recognizing and live in a world with high interdependence does not mean any requirement to coordinate policy.
Good. Okay, Christian Kopf, last question from Frankfurt.
Yes, thank you. On that note, Philip, are you concerned that the general public may care more about the risk of an overshooting of house prices than the risk of an inflation rate running slightly below the ECB's target, and that this concern may result in a change of the mandate, as we've seen in New Zealand?
So I think there's a related issue, but not the same. So, of course, the mandate of the ECB is in the treaty. So I leave it to others to think about whether any treaty change would happen. But what is true, and maybe I forgot to mention, is in our work on measuring inflation, we are looking again at this topic of whether a very important part of everyone's consumption is housing, and whether what the current setup is really appropriate, and whether more weight should be given to owner-occupied housing in the inflation measures we look at. So Christian, indirectly, or maybe more directly, depending on how you think about it, there is a relevant question of whether the inflation rate we are looking at should put a bigger weight on home ownership. But I would also emphasize is the issue about house prices, independently of consumer prices, is very much a topic for national macroprudential authorities, because it's not something that has a perfectly correlated trend across the euro area. There's a lot of differences across countries, and we know macroprudential policy can play a big role. And of course, when as governor of the Central Bank of Ireland, that was one of our major tasks, was to make sure the macroprudential framework provided a lot of stability in terms of the housing system.
If I could just squeeze in a final one for the audience, this has just come in, but it's very germane to what you were talking about, climate change. Are you willing to announce in September, when you come to the end of this, that you will take a fairly aggressive stance on the bond markets in terms of overriding market neutrality and deciding in your corporate bond purchases that you're going to set a certain set of standards for the bonds that you purchase in your program, those companies that do meet various climate change targets or do not over-emit carbon?
So again, that question has so much going into it, it's hard to give a yes or no answer to that. What I would say, and I think it's a fairly widespread understanding now, is when we think about market neutrality, It's important to think about that question in a deep way. And of course, there's a certain logic to saying we're passive, we just buy what the market issues. But when you have a situation where the sectoral composition of the universe of bond issuers is very different to the sectoral composition of the overall economy. So of course, small firms, especially in the services sector, don't issue bonds. And when it turns out that the sectors that have the large firms, which are natural bond issuers, are also the sectors which have a very high rate of carbon emissions, then there's an issue we have to face. Exactly how we address that issue, let's see. But the kind of the logic of market neutrality, let's define our terms there. If the market of corporate bonds exactly reflected the composition of value added, that's one basic asymmetry. And then the asymmetry connected to that is a deep asymmetry between the sectors who have a lot of emissions versus the sectors that don't. So there is an issue which we are currently looking at.
So it seems as though some kind of override might be expected, but let's wait and see. It is September, because you said very guardedly the second half of 2021, but I presume we can all go away thinking you are going to announce this in September.
Well, let me just repeat what President Lagarde said at the last press conference. Our deadline is the autumn. And if it turns out we solve all the problems before then, we'll let you know.
All right, good. Okay. Well, thank you very much, Philip, for taking us all through that. You've been guarded in some of your responses, but because we've got to know your guardedness, even your guardedness does send a certain signal, a certain message. So thank you very much indeed for the signals. You are treading a quite narrow path in lots and lots of ways, as you've indicated. Thank you for being so patient and answering our questions. And we look forward to the next interaction. Perhaps it'll be a physical interaction rather than a virtual one.
Sure. Very good. Thank you, David.
All the best. Thank you very much. Goodbye.
Bye. Bye.